Welcome back to the deep dive. You've tuned in at a really critical moment because today's market is, well, it's a structural contradiction wrapped in an enormous technical gap up. We are seeing S&P 500 futures signaling this massive bullish open, just screaming, risk on!
Hmm.
But our sources reveal that this initial surge is attempting to mask the absolute panic and distribution that define the closing hours of Friday. Our mission today is simple. We need to cut through this noise. We're going to break down the global caution, dissect the truly contradictory market internals, and pinpoint the specific catalysts that will either confirm this gap holds for a rally or...
Or if the underlying weakness causes the swift, ugly collapse.
Exactly.
It truly is a high-wire act, and that internal conflict is the defining feature of the day.
Yeah.
What our sources are showing is a battle between aggressive internal divergence and this elevated index-level risk aversion. All of it is hiding just beneath that surface-level technical optimism. For you, the listener, this is a setup that demands, forensic attention to the key price levels we're about to highlight.
Okay, let's unpack this. Starting with the overnight action, the global pulse. The general mood through the Asian and European sessions was really low conviction. We saw mixed to flat price action,
Yeah, very sideways.
driven almost entirely by some aggressive short covering right on the initial Asian Open. And then it immediately just transitioned into this long sideways consolidation. Nobody was eager to chase this move.
And that lack of conviction really shows up in the index performance details. Look at the small caps. The RTY, the Russell 2000 futures, they were the mild outperformer, up about, 0.15%?
Okay, so a slight risk-on tilt there.
A very slight risk-on tilt among the smaller companies, and its volume profile is, technically speaking, the most bullish of the major indices. But here's the conflict. Contrast that with the NQ, the NASDAQ 100 futures, which were actually slightly negative, down about 0.19%.
So small caps are catching a bid, but big tech is constrained. That just screams sector rotation uncertainty.
Exactly. Buyers are being very selective, not broad.
That brings us to the structure itself, and this is where it gets really interesting. Let's look at the technical damage done overnight using volume profile for the S&P futures, the ES. The 24-hour profile is printing a distinct P shape.
And you should explain why that matters.
Right. A P shape matters because it means we had very low volume at the bottom of the range and then a huge concentration of volume, the overnight point of control at the very top. That shape suggests the entire upward move was driven by short covering, not deep fundamental conviction.
So that point of control is the key level.
It's the critical price level. It's sitting right at 52.18.
$5,218.
Yeah.
So if the market can't sustain trade above that level after the open, the structure is just weak.
It's like a shallow foundation.
Absolutely. Failure to hold that point opens the door to a very sharp rotation back down. It could fill that massive gap in minutes. And if you look at the NASDAQ, the NQ, the hesitation is even clearer. It established a very tight value area, only 45 points wide, centered right near 18,358.50.
That's incredibly tight.
It's a textbook signal of low conviction. A break outside that narrow 45-point bracket will likely trigger a really aggressive momentum move in either direction.
Okay, now we shift from the technicals to the underlying health report section 2. The critical divergence in market internals. This is where the red flags really start waving.
They certainly are. Our sources flagged one number that is, frankly, alarming. The momentum signal.
The NYSE tick index.
The NY tick, yeah. It closed Friday at a massive negative, minus 568.
Wow.
Put that in visceral terms for you. A print below minus 400 signals, significant, broad institutional distribution. This wasn't just a few names selling off.
No, this was institutions aggressively bailing out of positions right into the closing bell. And yet, we have this incredible paradox in the put-call ratios, which perfectly captures the split psychology of the market. The index ratio, the SPX put-call ratio, hit an extremely bearish 1.26.
That reading is huge. It means institutional money is paying up for portfolio insurance, hedging against deep-seated systemic index risk.
But, and this is the key divergence, the CBOE equity put-call ratio, which tracks directional bets on individual stocks.
That was moderately bullish at 0.63.
A complete contradiction.
It synthesizes into a structural contradiction. It's like the institutional money manager has his fire suit on, aggressively buying protection against a market catastrophe.
Right.
But the individual trader is still running around in a t-shirt, happily taking directional risk on specific names. The consequence is clear. The broad market is operating under a heavy hedge, making it structurally vulnerable, but we are still absolutely in a stock picker's market. Alpha can be found, even if beta is weak.
Let's link that cautious sentiment to section 3. global macro headwinds. The global picture confirms that underlying cautious tone. We saw a synchronized decline across equities in Asia. The Nikkei was down 0.52%. Europe's EU 50 down 0.41%. That's a global risk-off mood pushing right into the U.S. Open.
And the flow of money confirms that defensive positioning. The U.S. dollar index, the DXY, is firming up slightly, which poses a mild earnings headwind for our U.S. multinational giants. And we see the same conflict in commodities. WTI crude oil is down, 0.73% due to global demand fears? That suggests growth concerns.
Gold is up.
Yet, gold is up 0.19% on a safe haven bid. When managers are simultaneously selling cyclicals like oil and buying defensive assets like gold, it confirms their priority is capital preservation over growth speculation.
And while that macro picture screams risk off, that 0.63 equity PC ratio tells us smart money is still finding individual winners. And that shows up in our pre-market movers. Biopharma Inc., BPIO, is up a staggering 18.3% on positive Phase 3 trial results,
Which could trigger some positive sentiment across the broader biotech sector.
On the flip side, proving the NQ's uncertainty, we have Global Tech Solutions, GTS, down 11.2% after a major analyst downgrade and a guidance cut.
And that carries negative spillover risk, especially for that already constrained tech complex.
Then there's Retail Holdings, RHLD, up 4.5% on M&A rumors and activist stake, testing that critical $90 psychological resistance level.
Which leads us right to Section 4. Today's volatility injection points, the calendar itself. This strong open is completely conditional on the data we are about to get.
So what are the biggest risks?
The two most critical drivers today are the UK Flash PMI and the US Import Price Index.
The UK Flash PMI hits early, 4.30 a.m. Eastern. It's labeled very high volatility. The critical line is 50.0.
Right, expansion versus contraction.
Consensus is expecting a slight contraction at 49.2. A print above 50.0 suggests an unexpected rally, but if it comes in significantly below 48.5, it will amplify global recession fears, and that will immediately challenge this bullish gap.
Then the domestic focus shifts to 8.30 a.m. Eastern with the U.S. import and export price indexes. This is an essential leading indicator of inflationary pressure that, it often gets overlooked.
So what's the scenario to watch for?
Here's the key scenario. If you see a significant month-over-month gain, say greater than 0.5%, that signals re-accelerating imported inflation. This means the Fed's job gets harder. It would cause a sharp knee-jerk sell-off in treasuries pushing yields higher and a spike in the USD. Both are restrictive for stocks.
We also have key pre-market earnings. For XPE, the Chinese EV maker, don't even look at the headline loss. Focus instead on Q4 2025 delivery guidance and, critically, their vehicle gross margin. Any sign of margin expansion will be a major positive catalyst for the entire EV space.
And keep an eye on HTHT, the hospitality company, because their earnings are a direct gauge of the Chinese domestic consumer. The operational metrics are more important than the EPS number.
So look at RevPAR, ADR.
RevPAR, ADR, the average daily rate, and the occupancy rate. Outperformance driven by a higher ADR suggests strong pricing power and demand. That's a structurally positive signal for global travel. Okay, so wrapping up in Section 5. Actionable summary and levels. We return to that conflicted open. The working hypothesis is risk on with momentum continuation, right? Signaled by that massive 51-point gap up in S&P 500 futures. But the market needs to prove this move is real. For confirmation, for you, the market must trade and hold above 67.7431.
Which was Friday's high.
Friday's high. Holding that level validates the gap. Your immediate invalidation alert is a quick reversal that drops below 67.3411.
So if the gap fills, momentum has reversed.
It has reversed, and you need to proceed with extreme caution.
And the absolute line in the sand, the level where the entire risk-on thesis just collapses, is the 50-day moving average at 67.0417.
A sustained break below that level puts us squarely back into the defensive posture that the institutional money is already signaling.
So today is defined by the struggle.
It's the struggle between a strong technical gap up and that deep-seated internal risk aversion. It's a battle of conviction versus institutional caution.
Exactly. And that tension leaves us with one provocative thought to mull over as you navigate the opening hours. Since the SPX put-call ratio has got that extremely bearish level of 1.26, does this extreme institutional pessimism truly represent heavy, necessary hedging against systemic risk? Or has fear reached a level that historically signals capitulation, potentially setting up a major, powerful contrarian bounce if the market manages to hold these key levels through the data releases? That's the knife edge we trade on today. Thanks for joining us for the deep dive. Apply this knowledge, stay vigilant, and you'll stay one step ahead of the market.